Hi, this is Adam Khoo here, and in this video I'll be showing you the various ways that stock investors can buy insurance to protect their stock investment portfolio for potential choppy waters ahead. So as an investor, even though I hold really good quality companies that I know will grow and increase in the long run, but in the short term, because of volatility, it can still go up and down. So what I like to do is, if I suspect that there's going to be some short-term volatility, I could buy insurance on my stock portfolio. It's kind of like, you're a healthy person and you're going to live a long life. Over time, you're going to get healthier, but at the same time, in the short term, things can happen. You could fall sick, you could get into an accident. So that's why we buy medical insurance. We pay a premium every year, a small premium, a couple of $100 to protect ourselves. So just in case shit hits the fan, we get hit by a truck or something happens, we get a payout from the insurance company that pays for the hospitalization bill. So we do that in real life for ourselves, and we should also learn to do that for our stock investment portfolio. Again, if you pick a good portfolio of great companies, you never need to sell them because they're going to go up in the long run, like Facebook, Amazon, Google. These are companies I own. Microsoft, that's going to keep going higher and higher over time. But in the short term, they could go down because of volatility. And if they do go down, I want to get a payout from the market by buying insurance. Now, if you don't have any stocks that you own, you could also use this technique to profit as the market goes down in the short term, as it goes through some choppy waters. So why do I believe that some choppy waters could be ahead? Well, because of seasonality. So just as the weather has seasons, the market has seasons as well. Okay, so if you take a look at the last 20 years, and the S&P 500, it tends to rally during certain months and tends to sell off in certain months. And again, this is not 100%. It doesn't happen every single year. It's not like, same thing, not every year it would snow in December, right, in certain countries. And not every year is going to get really hot in summer. Sometimes it goes the opposite. Okay, so this is not 100%, but it gives us a rough guide as to what could happen to prepare for the possibility, right? So you can see that based on seasonality, the markets tend to rally strongly, all right, in March and April, and then it kind of like goes sideways, consolidates from May all the way to about September. And September to October, there's normally a bit of a sell-off there. Interestingly, if you look at history, all the major crashes happen in October, right? The crash of 87, the great financial crisis, they all happen in October. For some reason, it's known as the jinx month, right? But what happens is the market tends to bottom at the mid of October, and then it rallies strongly towards the end of the year, capping off with the Santa Claus rally. Of course, this year could be different for two reasons. Number one, because of the COVID-19 bear market crash at the beginning of the year that could have disrupted this pattern, right? The second reason is because it's election year in the US. November will be the presidential elections. So again, what happened this year? This year, we started off pretty well in January, and then COVID-19 happened, and we had that big crash, all the way down, right? The market was down 36%. But since then, we have rallied really strongly to where we are right now. We are now towards the end of June, and we have recovered most of the losses from that bear market, and we are just sitting about 5 to 6% below that all-time high. So again, remains to be seen if this year is going to follow the seasonal pattern. Now, again, if it does follow the seasonal pattern, we could see some choppiness in July, August, and we could see a sell-off, probably like a 5% sell-off possibly. And then we have that end of the year rally, all right? So like I said, we can't predict the future, but it's always good to prepare. It's like, I can't predict when I'm going to fall sick. Hopefully I never fall sick, but I know that I have to fall sick, once in a while. And that's why I buy health insurance every year just in case, okay? Even though I keep as healthy as possible. So we have to buy insurance to protect our investment portfolio during flu season when our portfolio could potentially have some volatility. All right. The other reason would be because of the elections. Now, what happens during an election year? Well, it depends on who wins. Okay. So now this is based on a historical stock price performance. And what you can see is that when the incumbent party wins, in other words, if the current president of the White House wins, you can see that the market tends to rally very, very strongly towards the end of the year, right? Same pattern, except the rally is really strong. But if the incumbent party loses, the current president, who's Trump, if he loses and Biden wins, you can see the market still rally after the sell-off, but doesn't rally as strongly, all right? So does it mean that a Republican president is better for the stock market compared to a Democrat like Biden? The answer is not really. So this is how the stock market has performed in the past over the last 50 years under 8 different presidents, some Democrats, some Republicans. So Republicans are those in red. You've got Richard Nixon, Ronald Reagan, George Bush Sr., George Bush Jr., and of course the current Donald Trump. Under the Democrats, we've got Jimmy Carter, we've got Bill Clinton, and we've got Barack Obama. And you can see that under the Republicans, right, under Richard Nixon, right, market went down. Ronald Reagan was great, went up a lot. George Bush Sr. went up as well. And then, of course, George Bush Jr., right, that was terrible, right? Yeah, both the dot-com crash and the great financial crisis. And of course, Trump started strong, but this doesn't factor in the COVID crash. After that crash, well, it's somewhere about that, all right? Now, if you compare it to the Democratic presidents, okay, so Jimmy Carter, Democrat, went down. Bill Clinton was fantastic for the stock markets, and Barack Obama was also fantastic for the stock market. So if you take an average, you can see over here, right, and this goes back even further all the way to Teddy Roosevelt back in 1901, right, who was, a Republican. So again, red would be Republicans, blue would be Democrats. So you can see that since 1901, right, 1901, that's like, 100 years, right, the average return of a Republican president has been 3% a year on average. All right, and this is based on the Dow Jones Index, okay? But the average Democratic president has caused the stock market to return an average of 6.7%. Total percentage gain for Democrats has been 86%, gain in the stock market, for Republicans 44%. So you can see that based on the last 100 years, a Democrat president, right, causes the stock market to gain double compared to a Republican president, all right? So it's interesting. So basically what I'm saying is that if Joe Biden wins, in the short term, it may not be that great for the stock market. Stock market will not rally as strongly, but in the long run, based on history, the stock market should perform even better under a Democratic president. And again, this is not my opinion. These are facts from the last 100 years. Right, so let's look at where the stock market is right now. This is the S&P 500 index. Now, I can also take a look at the SPY, which is the S&P ETF. Let's go to the SPY because it moves together and you can buy and sell the SPY. All right, so there we are. I've drawn a few lines, but let me get rid of the lines so that looks a bit clearer. There, right? So since we bottomed in late March, right, that again was the bear market, we have been on a very, very strong uptrend. As you know, on an uptrend, it doesn't go up in a straight line. Again, it goes through wave patterns of impulsive and corrective waves, right? So we've got wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down, okay? So as long as we keep making higher highs, right, and we make higher lows, the uptrend is very, very much intact. And currently we are kind of like consolidating about there, and we are seeing pretty strong support at these levels over here. All right, so the uptrend is still very much intact. So currently we are in the middle of June or towards the end of June, and like I said, if seasonality plays its part this year, we could see a potential choppiness, and probably in anywhere from September to October we could see a sell off. Now, how much would it sell off? no one can predict, but based on history, we expect about at least a 5% sell-off before it rallies back up again. All right. So my guess is that if we sell off, we could potentially sell off to this level over here. Why? Because there's a strong level of support at 273. This is on the S&P 500 ETF, the SPY, 273. Okay. If we use a Fibonacci retracement, and if we take that A wave to, if we take this as one big impulsive wave, and if this happens to continue retracing down, this would be roughly the 50% retracement level, which again coincides with 273. So my base case, if we sell off, is we will sell off to about 273. Of course, we could even go down to the 61.8% level, which is 258, right? So that would be the zone that we could sell off to, and from there we could potentially then continue the rally towards the end of the year. All right. So again, how do we buy insurance so that if the market does go down, we get a payoff, right? We can profit from the market going down. Or if we've got a stock portfolio, how do we buy insurance so that if the market goes down, we get profits to offset the temporary loss in our portfolio? Because we know in the long run, the portfolio will still go up, but in the short term, it could go down temporarily. How do we buy insurance? So we pay a premium and we make money if the market goes down. There are many ways to do it. The simplest way is to just buy a put option on the S&P ETF, buy a put option on the SPY. Again, if you're not familiar with options, please watch my introduction to options. I've got many free videos on YouTube. Just type Adam Khoo options, go watch it, go binge watch it so you understand what's an option, right? So I assume you know a bit about options. So if I buy a put option, I'll just click on trade over here. And what's the expiry date of the option? So when I buy insurance, I want to insure myself for a certain period of time. So in this case, I could insure myself all the way to October. So I'm going to buy the put options that expire on the 16th of October to protect my portfolio for 113 days. Okay, so if I buy a put option, I'm going to buy, say, at the current market price of 304. So I'm going to buy the put option. Let me just scroll down. There we are. Okay, so that's the put option over there. Strike price 304. So by buying this put option, it gives me the right to sell the shares of the S&P at 304. So even if the S&P goes to zero, I have the right to sell it at 304, essentially, right? So a put option is such that the lower the market goes, the more money I make. Now, the trouble with just buying a put option is that it's really simple, but it's very, very expensive and it's not that efficient, right? But I'm going to show it to you anyway, right? So if I buy this put option, it's going to cost me quite a lot of money. It's really expensive. You can see if I buy this put option, it's going to cost me $19.57, right? And one contract is 100 shares. So which means one contract is going to cost me $1,957, $1,957, almost $2,000 for a contract. And that's pretty expensive, right? But I'm just going to show it to you anyway. So I'm going to click buy, ready, boom. All right, so I'm going to buy this contract again. You can see over here, it's cost me $19.57 times 100. That's 1957. Now, let me show you what it looks like over here. So you can see that if the stock market doesn't go down, if it goes up, what happens? That's right, I lose my premium. It's like you buy insurance, if you don't get sick, you don't get your premiums back. So essentially, my maximum loss is $1,900. I must be willing to lose $1,900, right? Of course, if the market crashes all the way to zero, I get, $28,000. Now you may say, wow, that's not bad. I'm betting $2,000 to make 28 grand. Yeah, but come on, the market's not going to go to zero, right? Of course not. It's going to drop just 5%. That's it. So let me show you what the profit and loss loss chart looks like. Looks something like this. There we go. Now, remember, every time you put on a trade in the market, you have to study the profit and loss graph. How much do you profit when it goes in your direction? How much you lose when it goes in the other direction? And you have to know all the risks and rewards before you enter trade. So over here, you see the profit and loss graph. Now, on the y-axis, you can see this is 0, right? And anything above that would be profit. So that's 1 grand profit, 2K, 3K, 4K. So that's profit. Now, anything below 0 is loss. You're losing money, right? So you're losing 1,000, 2,000, 3,000, so on and so forth. On the x-axis, we have got the stock price. Now, the current price of the SPY is 304, right? Can you see that's the current price? So if the market goes up, right, what happens? The market goes up, I will lose money, all right? It's below 0, I'll lose money. Now, but if the market goes down, market crashes because of the seasonality, what happens? Then I will make money, all right? So you can see the profit graph is that the more the market goes down, the more money you will make, all right? But if the market goes up and doesn't go down, you will lose money, but your loss is capped to the $1,900 you paid for the option. So let's take a look at the different possibilities, right? Okay. So over here, you can see that this simulates that the market goes up by 10% to 334, or the market goes down by 10% to 273. So recall I said that if the market goes down, my guess is that it's going to go down to about 273, right? So that's about a 10% drop from current levels. Okay. Now you see two lines. You see the green line and the purple line. The green line is the profit and loss at expiration, which is on the 16th of October. And the purple line is the profit and loss right now based on this current date over here, which is, current date is 25th of June. So I've got to change this to 25th of June. There we go. All right. So the purple line is today. The green line is on the 16th of October. Now, as time passes, what happens? As time passes, you can see over here, I'm going to simulate as time passes, right? Notice that the purple line will drop to the green line. So the longer I wait, or the longer it takes for the market to go down, the less money I make. If the market goes down straight away, I make more money because the purple line will be a lot higher, right? So let's simulate. Let's assume that the market drops in a month, right? Or okay, say it drops in 2 months from now. So that will be August 25th, right? So over here, I'm going to simulate and I'm going to go to August 25th, right? So what happens on August 25th? On August 25th, or rather by August 25th, if the market drops to 273, I will make, let me zoom in where you can see this clearly, I will make 1377. Can you see that white thingy over there, 1377? Okay, so this is 1377 per contract. Okay, but if the market doesn't drop and the market goes up instead by 10%, how much do I lose? I will lose $1,600. So, is that a good deal? No, it's not a good deal, right? Why? Because if I'm wrong, I'm going to lose 1,006. If I'm right, I'm only going to make 1,003. That's not a good deal. That's almost 1-to-1, right? And that's why if you just buy a put option, all right, it's not that profitable because it's really expensive. Okay, so unless the market crashes by 20 or 30%, it's worth your while. But if the market just goes down 10%, you know, you're risking 1,006 to make 1,004, 1,003, not that worth it. All right, so scrap that idea. So what else could we do instead? Second alternative would be to create a put spread, a vertical spread, which means I not only buy this 304 put option, I will also sell a 273 put option. Because if I think that the market is going to go to 273, when I sell the 273 put option, I'm going to collect premium, and I use that premium to finance the 304 put option. We call that a put spread. So let me show you how that works. So I just go to 304 again, and this time I'm going to select a vertical spread, right? A vertical spread. So this time I'm buying one option, I'm selling another option. Okay, so I'm going to buy the 304 and I'm going to sell the 273. Now again, why 273? You may ask, because that's where I think the market is going to drop down to if it drops down. There we go. So by buying the 304, selling the 273, the cost of my trade goes down to $8.99. So it's a lower cost trade, but it's still expensive. It's still $899. So later I'm going to show you a way to buy insurance at a very low cost. All right, but you can see it's still expensive. Now with this method, if I show you how the trade looks like right now, let's analyze the trade. And again, I'm simulating that it's going to go down on the 25th of August, which is 2 months from now. Now again, the earlier it happens, the better it is. But say it happens on the 25th of August, right? Okay. So again, right now we are here at 304. Market goes up 10% or market drops 10%. Two scenarios, correct? Okay. So in this case, if the market goes up by 10%, which means, you know, I'm wrong that it's not going down, what happens? I will lose this amount. And how much would I lose? If I put my mouse over there and I zoom in, you can see the figure. I lose 660. Okay? So this time, if market doesn't go down, I only lose $660. Not as bad as losing 1,006, which was the previous example, right? This time, that's the cost of me buying insurance. But if the market does go down by 10%, right, and it goes to 273, how much money do I make? I'll make $1,000, right? I'll make $1,000 on the 25th of August, okay? So in this case, the risk to return seems a lot more favorable because I'm risking 600 to make 1,000. All right, so roughly that is, let me work that out. That's 1,000 divided by 660. That's 1:1.5. So essentially, I'm paying $1 in insurance to make $1.50 payout if the market goes down. It's a bit better, but again, it's not that exciting. It's still too expensive. Could there be a better way? All right. Now, by the way, if the market goes down 10% and I leave it to expiration, right? As you can see, as it expires, what happens? As it moves towards expiration, the purple line will start to move towards the green line. And if I hold it to expiration, which is on the 16th of October, then of course I could make all the way to about $2,200. Where in this case, I'll be risking 600 to make $2,000, which is risking 1 to make 3, which is better, all right? But again, is there a better way? And the answer is yes. So the last method I'm going to show you is the lowest cost method that gives the best risk to return ratio in protecting your portfolio. All right, so the third method you could use to make money if the stock market crashes is to actually buy options on the VIX, the VIX. Now, what's the VIX? The VIX is known as the volatility index. also known as the fear indicator, right? See, what happens is whenever the market goes up, the VIX comes down because people are less scared. But when the market goes down, the VIX goes up because people are fearful. So the VIX goes opposite of the S&P 500. Now, what does the VIX look like? This is the VIX, VIX. All right, so you can see over here, right, that when the market crashed in February, what happened? People were so scared, oh my God, right? And the VIX, the VIX, went up. Whoa! Again, this is the fear index. People are scared. When they're scared, it goes up. Can you see that? And when the market started recovering, people said, okay, I'm not that scared anymore, right? So the VIX comes down, right? Okay, and then people get scared again, goes down again. There we are, okay? So this period over here, you can see that when the market kept going up, last year, the market went up like 28% in 2019, right? So when the market's going up, people were not fearful, so the VIX was very low, okay? So if the market does sell off in the next few months, what's going to happen to the VIX? That's right, the VIX is going to, oh my God, go up, all right? So another way to make money when the market crashes is to buy the VIX. But here's the thing, you can't buy the VIX. You can only trade options on the VIX. Some of you are thinking, can I buy a call option on the VIX? Don't even try. It's too damn expensive to buy a call option or call spread on the VIX. But there's a way to make money when the VIX goes up using a different strategy known as a back ratio strategy, which is low cost and really, really high returns. Now, what the heck is that, right? How does it work? I'm going to show you in a short while. But before that, let me show you this chart as well, right? So you can see that historically, the VIX tends to be higher in the second half of the year, all right? And historically, you can see that the first half of the year, from January to July, the VIX goes down because people are not scared. But for some reason, from late July, which is coming soon, people go, oh my God! People get really scared. So the VIX flies all the way up. And then, again, towards the end of the year, when markets go up again, all right, I'm not scared anymore, right? So we want to capture this jump in the VIX. Okay, so how can we do that in a very low cost way? So one of the things I do is I buy what is known as a call, I buy a back ratio spread. And this is how it works, right? So basically, I'm going to sell a call that is just out of the money and buy two more calls further out of the money. All right, so currently the VIX is trading at 32, right? 32. So the first thing I'm going to do is to select the expiry date. Now, in the previous two examples, I selected the October expiry. But for this method, because it's so cheap, I can afford to buy a longer expiry and to insure myself a lot longer because it's so cheap. And I'll show you how cheap. All right, so I'm going to choose the November expiry. So in other words, I have 145 days of protection in case there's a sell-off. And what I'm going to do is I'm going to, again, like I said, sell an out of the money call option and to buy two further out of the money call options, creating a back ratio spread. So for the first call option, I'm going to choose just out of the money, say at about 40 strike over here. And I'm going to select what is known as a back ratio. Okay, back ratio over here. Click on that. So you can see now I'm selling the 40 call option and I'm going to buy two of the 50 call options because the 50 strike is further out of the money at about 30 deltas, right? So the first one is about 40 delta, next is about 30 deltas. And again, if you don't understand delta, please watch my options introduction videos. Okay, so by doing this, what's the cost of this trade? Ta-da! $1.20. You can see how cheap this is compared to the other, methods that most people use to hedge their portfolio. So in this method, my cost is $120. per contract. Again, I can buy many contracts, right? Just buy one contract, $120. So what happens if the market goes down and the VIX goes up? Let's take a look, right? So I'm gonna simulate the trade. Boom. Okay, so again, we always look at the profit and loss graph to simulate our profit and loss. Okay, so first of all, look at how this trade looks like, right? So again, the current price is 32. That's where we are right now on the VIX. And again, if the market drops and the VIX goes up, what happens? You can see from this line, you become very profitable, all right? The more the VIX goes up, the more money I make. But if the VIX goes down, because people are not scared anymore, the market keeps going up, what happens? Right? You can see that I will not make money. But the great thing about this approach is you can see that how much would I lose? If the VIX goes down from 30 to 20 to 10, how much do I lose? That's right, I lose very little. Guess what? I only lose $120. All right, I can only lose $120 if the VIX crashes down. But if the VIX goes up, hallelujah, I could make a lot of money, right? So how much money could I make? Well, again, let's simulate. All right, so currently it's 26th of June right now. Consistent with the other two examples, we'll assume the market's going to crash, or not really crash, but sell off in 2 months, the 25th of August, right? So over here, I'm going to simulate the 25th of August, right? Click, and I'm going to go to 25th of August. And boom, right? So you can see the purple line drops slightly. The more time that passes, the more the purple line will drop down. So of course, the faster the market sells off, the better profits we make, all right? Okay, so let's look at the different scenarios. So scenario number one is that the market doesn't sell off, and again, the VIX drops, all the way, or whatever it is. And again, the most I lose over here would be $120, right? Now, if the VIX goes up to 55, right, which is what I expect, how much do I make at 55 VIX? Okay, so if VIX goes to 55, you can see I will make the profit on the purple line, which is 457. 457. If it happens in 2 months, I mean, if it happens earlier, I make even more, all right? So in this case, I'm risking 120 to make 457, and that gives me a risk to return of 1:3.8. That's not bad, right? Roughly about 1:4, okay? Now, if the market really drops significantly and people get really scared and they freak out, oh my God, then guess what happens, right? The VIX could go up to, 80, which is what happened during March, right? During the COVID crash. Now, if it goes to 80, how much money do I make on the purple line? I will make 2,191. You can see on the bottom left-hand corner, the profit is 2,191. 2,191. That's not bad, right? From $120 buying insurance, the insurance company will pay out $2,000, right? So, what's the payoff, right? Payoff would be 2,190 divided by 120. The payoff would be 1:18. Right? So basically, this method really can be profitable if the market freaks out. Right? If all hell breaks loose, you make 1:18. Okay. Now, one thing that's really important about this strategy is that you have to watch it very carefully. Why? Because some people say, okay, Adam, are you saying that the worst that can happen is I lose $120? Is that the worst that can happen? Can I lose more than that? And the answer is yes, you can lose more than that if this happens. Now, can you see this green line? Remember, the green line is the profit and loss at expiration, right? So if you hold the trade to expiration, which is the 18th of November, the purple line will drop down to the green line. And if it drops down to the green line and the VIX is at 50, you could lose, oh my God, you could lose $1,000. Right? So to avoid losing money, right, to avoid losing more than 120, you have to get out of the trade, to close the trade before the purple line drops below that zero line. And that's why I say you have to watch it really carefully. Now again, notice what happens, right? So on the 25th of August, that's the purple line. Now, if you wait to the 25th of September, for example, right, what happens? Boom, the purple line is now dropping, okay? What happens on the 25th of October? Or rather the 25th, right? Boom. Can you see by the 25th of October, the purple line drops down, which means that you could be losing money, all right? And you lose about, well, if the VIX is here, you lose about 331. You lose $331, okay? And that's why for this strategy, I always get out. I close the trade before the purple line drops below that zero line break even. And in this case, that happens roughly on the 25th of September. So I got to get out before the 25th of September. You may say, Adam, what if you get out and then the market crashes, right? Well, if I get out, guess what I do? I place another trade. So the same thing happens again. I have another 2 months for insurance, right? And each time I only pay $120. But if it crashes, I make $2,000, hallelujah, per contract, right? So you can see that when you learn options, there are so many things you can do with it. And it's so powerful because it allows you to make money in any direction. And if you enjoyed this video, great, right? But it's only 1% of what you can learn about options, right? That's why we have the professional options trading course, both the basic and advanced course. If you're interested, do check it out, right? You can go to piranhaprofits.com, email us for a discount coupon, and learn about options on how to protect your portfolio, all right? Now, if you have no stocks, but you think the market is going to crash, that's a pretty good strategy, right? You know, betting $1 to make $18. Why not? Better than going to the casino, right? So this is Adam Khoo. May the markets be with you, and subscribe to this channel for more videos. So if you want to be the first to get my next video on YouTube, do click the subscribe button right now. If you want to check out my online courses, go on to piranhaprofits.com, where you can enroll in our professional Forex, stock trading, options trading, and value momentum investing courses, where you're going to learn how to trade like a professional and generate an income anywhere in the world. If you would like to come to Singapore to attend my live classes, Wealth Academy, go on to wealthacademyglobal.com. It's Adam Khoo, and may the markets be with you.